The time has finally come, the moment you've all been waiting for. I am here filming without a black t-shirt on. I have my party jacket on. I wear this when I hit milestones, and I recently hit 4,000 subscribers, so I figured I'd put on my party jacket. Here I am. There's no reasons to wear jackets anymore in life, so we have to find reasons to still dress up. If you haven't already, hit that subscribe button. It would mean so much to me. I would really appreciate it. I do tons of videos like this covering disruptor companies, EV stocks, tech stocks, the best stocks to buy every single month, anything and everything personal finance. You don't want to miss any of that. So hit the subscribe button. While you're down there clicking things, absolutely decimate that like button. I would really appreciate it. It appeases the YouTube algorithm and helps my channel grow and reach new people. And most importantly, I would really appreciate it. All right, without further ado, let's get right into it. Unfortunately, we may all be aware we are currently living in an unprecedented time. If you weren't aware of that, yet you were watching YouTube videos, congrats. If you find an overwhelming theme to all these stocks I've chosen, well, it's because there is. Make sure to watch the analysis of each stocks themselves as I highlight great buy entry points. I go over current financial situations, their current business operations, future operations, and great buy entry points for each stock. All right, the first company I want to talk about has the current health situation by the horns. With gyms and workout clubs being absolutely shuttered by the current health situation, many companies have greatly benefited from this. Working out from home has become increasingly part of the new normal we keep hearing about, and no company has benefited more from this than Nautilus. Nautilus is an absolute powerhouse in the fitness equipment sphere. They are based in Washington, United States, and are developers of basically all of the well-known home workout companies such as Bowflex, Modern Movement, Universal, Nautilus, Octane Fitness, and Schwinn Fitness. I am not kidding when I say that early investors of Nautilus after the crash happened in March may indeed well be millionaires simply due to the insane upside this company has seen in a relatively short period of time. They are up over 1,400%, going from $1.20 to over $20 per share. From the way things are going, our current situation won't be likely over anytime soon, and gyms and workout spaces may be some of the last industries to fully recover. Another stream of thinking is that many people won't likely return to gyms and workout spaces due to lingering fears from the current health situation. Nautilus is a very volatile stock. However, this is due to the insane surge it has felt over the past few months with a beta value of 2.10. It doesn't have a PE due to negative earnings, doesn't pay out a dividend. It is a small cap company with over $640 million market cap. Nautilus is posting a forward PE of 16.50. It has a forward price to book of 5.77, which is actually quite high currently. They have a profit margin of minus 2.22%. They have a return on equity of minus 8.42%. They have a current ratio of 1.86, indicating more assets relative to liabilities. And they have $45.66 million in cash and cash equivalents. They generated $373 million in the trailing 12 months. However, their cost of revenue and operating expenses were very high at $233 and $123 million respectively. It's clear that Nautilus still has much work to do. They are going to rapidly need to reduce their cost of revenue and operating expenses to increase their gross margins in the coming quarters. They are sitting at an analyst rating of 1.8, 1 being a strong buy and 5 being a strong sell. Nautilus, in my opinion, will continue to do well in the coming quarters and will become a bigger presence in people's lives and homes as we discover the new normal. I am personally aiming for a re-entry point around the $17 or $18 share price if they can return to these levels. I think they will be a phenomenal long-term buy. In keeping with the working from home theme and the increasing amount of people spending more time at home, the next company has been my personal top performer of the year. It really has blown my expectations out of the water. It's such a top performer. It's a company I love, it's a company I believe in, and an item I love. The company I'm talking about has been the story in the home fitness sphere, Peloton. I would be extremely surprised if you've never heard of this company. They have basically revolutionized the way people ride stationary bikes with a virtual trainer akin to a spin class. They are, in my opinion, bringing over a lot of pre-existing customers who used to spin and the at-home stationary bike market. They're currently hovering around $110 USD per share, which is incredible, as it feels like just a few weeks ago they were in the 30s and 40s. They are an enormous company with over a $30 billion market cap, a shaky PE with minus 2.11, don't pay out a dividend, and in my opinion are way overvalued right now. However, I think they will continue to increase in price and will become even more overvalued as investors are pricing in their long-term potential. Investors are realizing that Peloton has really harnessed the current situation in making people feel connected and bringing a sense of normalcy and joy back into working out. I think in the coming winter months, Peloton will have another massive surge in share price. They have a very high forward PE of 232. They have an extremely high price to book of 15.24. They have a bad return on equity of minus 6.88%. However, have a great current ratio of 2.80 and have $1.76 billion of cash and cash equivalents on hand. It's clear Peloton has much work to do. However, this is to be expected as they are a new startup company revolutionizing the home fitness sphere. It's understood that startup companies producing an actual product will have short-term struggles. However, they have the potential for huge long-term gains. They have tons of revenue coming in with $1.825 billion. However, just like Nautilus, they have an extremely high cost of revenue and operating expense eating away at any potential profit. In the coming quarters, watch for Peloton to minimize these operating expenses and cost of revenues to increase their margins. I really love this company. I love Pelotons in general. They are really revolutionizing the way people work out and think about riding stationary bikes. The third company I want to talk about is an absolute powerhouse in the tech world. It's a company you've all heard of before. It's a giant in fintech and has really created a name for itself in the past few years. The company I'm talking about is PayPal. With the health situation changing the world we live in and forcing more and more transactions online, PayPal becomes increasingly well positioned for the movement of capital through apps. PayPal had a record-setting Q2 with total payment volume yet again increasing to $222 billion, which was 29% year-over-year gain. They now have 346 million active customers using their platform and added 21.3 million just last quarter. It's clear PayPal is continuing to grow and continuing to grow at a rapid pace. PayPal, along with most tech stocks, is quite pricey. They are hovering around 190 USD per share. It is a large cap company with a market cap of 224 billion. However, it is quite stable with a reasonable beta of 1.11, a PE of 87, and an EPS of 2.18. PayPal has a price to book of 13.11, a forward PE of 44.05, a fantastic return on equity of 15.27. It generated 19 billion in revenue and had almost 8 billion in gross profit. It has a current ratio of 1.38 and has 13.05 billion in cash on hand. It's clear this company is so well positioned for the future. It's really stable, and this company has a position within the top performing companies for the foreseeable future, hence its incredibly expensive share price. As more and more transactions move online, PayPal will become increasingly important and crucial for these transactions to take place and will benefit from all of these transactions. PayPal is currently sitting at a 1.9 in between strong buy and buy with an average price target of 219 USD. Like I said before, this is a very safe bet. It is not volatile in the least. It has a ton of cash on hand. However, I would look for a big dip day in order to gain entry into this stock. All right, moving on. The next company I want to talk about is one of my favorite REITs or real estate investment trusts I own currently. REITs are basically an umbrella company dipping their toes into many different real estate operations akin to an index fund. This REIT I am talking about is called Welltower Incorporated. The reason I love this REIT so much is that they are centered around senior housing, assisted living facilities, memory care communities, and post-acute facilities, and most importantly, hospitals. They are extremely well diversified in the healthcare sector and are poised to see very reliable payments even in our bruised economy, especially in the bruised real estate sector. This sector, healthcare, will see an increased importance, in my opinion, in the coming quarters and years, and Welltower is very well positioned for the coming landscape. They currently have a share price of around 56 USD. However, they have an extremely high delta with a 52-week high of 93 and a 52-week low of 24. They are a large cap company with about 24 billion market cap, a PE of 17.82, and yes, they pay out a dividend, and they pay out a very nice dividend at that of 4.25%. They have an earnings per share of 3.16, a very low beta showing stability of 0.87, a forward PE of 51, a very low price to book of 1.43, a fantastic return on equity of 8.17, and a fantastic profit margin of 26%. They generated almost $5 billion in revenue, and their trailing 12-month gross profit is a whopping $2.41 billion. They have a great current ratio of 3.76, have $1.68 billion cash on hand. They have a 2.8 analyst rating between a buy and a hold. Welltower is a great company if you want exposure to the real estate sector while keeping it safe and secure. They are reliable and are poised to have an increased importance in the coming quarters. They pay out a great dividend. What's not to love about this REIT? Last but not least, we are moving on to one of my favorite companies, the first stock I ever invested in. I will continue to hold this stock for the rest of my life. Mark my words, Microsoft. I've talked about this company before and how they are one of my favorite companies I own. I love almost everything about this company. They're great management. They pay out a dividend even though they are a tech company. It is an extremely safe and reliable place to put your investments. Microsoft is extremely well rooted in the tech sphere. They have branched out into cloud computing and developing software. They have a gaming platform, Xbox, everyone knows about. They have their hands in everything, are so well diversified and fortified and wide-moated. Everyone I think is familiar with Microsoft, however, many people don't understand how well they are currently valued in comparison to other tech stocks. They have an extremely low PE in terms of tech stocks of only 35. They are a gigantic company with a market cap of 1.55 trillion. Yes, that's trillion with a T. They have a very respectable dividend payout of 1.06%, which is basically unheard of in tech stocks. Can you tell how much I love this company? It's incredible. They have a great EPS of 5.76, an even lower forward PE of 31, a decent price to book of 13, a phenomenal profit margin of 30.96. Wow. A return on equity of 40.14, wow, times 2. Generated 143 billion in revenue, wow, times 3. Have 136 billion in cash and cash equivalents, wow, times 4. And have a current ratio of 2.52, wow, times 5. Guys, this one's a no-brainer for me. If you want an extremely stable, well-fortified, wide-moated tech stock, this is your answer. There's really no question here. Yields may be quite softened in comparison to other tech stocks with more upside, but really you're buying security with this company. They're currently sitting at a 1.7 in between strong buy and have an average price target much higher than their current share price. Like I said earlier, Microsoft continues to innovate and put themselves into great positions for the coming landscape. They really are one of my favorite companies. They are so well diversified. I still love the tech sector. This company will continue to perform, mark my words. I cannot wait to see what they do next. Anyways, guys, I hope you loved my 5 picks. I really did put a lot of time and effort into picking these specific 5s. I'm not just spewing out any 5 companies. These really are some of my favorite companies, and I think they will continue to perform and outperform the market in the coming quarters. I really do practice what I preach. I am invested in all 5 of these companies and will continue to invest heavily into them. Let me know what you think about the picks in the comments below. Hit that subscribe button if you haven't already. Thank you so much for 4,000 subscribers. Got my cool jacket on because of it. You guys really do make this possible. I know how cheesy that is to say. What's even more cheesier is if you could decimate that like button. I would really appreciate it. Anyways, guys, I'll see you in the next video. Stick to the plan as always. Cheers.